Hello, hello. So Target reported earnings and it's down significantly, like 15%. At some point it was down even more, I believe. And you will see it pretty much reflected over here in the chart. Now we're going to be taking a look at what happened during the earnings report. Why is the stock down that much? Target shares plunge after retailer reports profit decline and warns of a soft holiday quarter. So both of these things are bad. I mean, of course, there's a decline in profit and also the guidance. Guidance is very, very significant right now, especially amidst a period where people are expecting a potential recession. And so investors get scared if that happens and they tend to sell off these companies. Now, Target is cutting its fourth quarter outlook, again the guidance, after seeing sales slow in late October. And for the fourth quarter, where you expect sales to be higher than than normal, this is a bad thing to hear from a company of this sort. It also plans to cut up to $3 billion in total costs over the next 3 years, which is the good thing about what has been happening with Target. But still, it has caused a pretty significant decline over here. Now, Target's profit fell by around 50% in its fiscal third quarter. That's super significant, as you can understand, through unwanted inventory. I remember at some point when the stimulus was out, companies bought quite some inventory because people had extra money, and then this effect kind of slowed down. And in some situations, they are getting some unwanted inventory, especially the things that are potentially, not really needed, but people want them, generally speaking, in a booming economy, like televisions, for instance. But when things go down and there's not too much money circulating, there's inflation and things of that sort, then you are getting this kind of unwanted inventory and slowdown in sales, which is what's happening over here with Target. And as you'll see, the company also said it plans to cut $3 billion, which we talked about earlier. And the retailer's revenue has grown by about 40% during the COVID pandemic. Again, this may have had to do with the stimulus as well. A very important thing. Now, here's what they did in regards to the sentiment and see how close it was. Earnings per share of 1.54 versus 2.13 that was expected. A pretty steep decline, as you can understand over here. Very significant surprise. And in terms of revenues, 26.52 billion versus 26.38. They beat on that. So they basically couldn't beat on earnings over here. It's basically the earnings that actually went down significantly over here. And sales decline as families contended with higher prices, trade-offs between what they need and what they want, what I talked to you about earlier. And the inflation factor, of course, obviously very important over here. Now, we're going to take a little bit of a look at the company and its financials because we don't really care about what is happening right now. We care about buying companies that are good and that can actually provide us with some nice returns over the years. If you take a look at the 5-year chart of this one, it is a company that has been growing quite significantly in the past few years. And with Target being pretty much a discount store, growing that much is quite significant. These kinds of companies tend to do well even when there is a recessionary period. Yet this one is down quite a lot, maybe not as much as some other like tech companies, for example, but it's still quite a lot from where it used to be 1 year ago. And right now sitting at $150, is it a good buy? And especially a defensive buy through a potential period of maybe a recession? Let's see. In terms of the P ratio, the company is doing 17. This is probably going to go a little bit higher since their net income was actually worse this time. But the price to free cash flow 13.6 also. So generally speaking, this is okay, but it's not too cheap because remember this is a discount store. It's not like a tech company, so you can expect these kinds of valuations here or lower even. In terms of outstanding shares, they have been buying back shares, which I obviously like. I love actually, because when they do that, they actually reward investors with increasing the value of the current outstanding shares count. And so when you have some shares, your shares are now inherently worth more when they're actually buying back some of their market shares and pretty much retire them. In terms of the total liability to free cash flow, it's a little bit elevated, but again, you can expect this from this kind of company. Having a little bit of extra debt. But the numbers are looking pretty nice over here. Net income that is growing, free cash flow that is growing, pretty much everything looking nice over here. And in terms of the net income margins, the margins are low and they have been getting a little bit lower again amidst this kind of environment right now. As you'll see over here, when we're approaching like December, this is getting much lower. And this is one of the reasons, obviously, why it actually caused this decline in their net income, of course. Yeah, the return on equity is pretty nice. Now, an important thing with these kinds of companies is the dividend, because these companies, typically speaking, they don't move that much, although Target has moved quite a lot. But what you buy them for, one of the core reasons why you are buying these companies is the dividend. And this one is paying 3.2%, which is a 44% payout ratio in terms of its free cash flow and 53% in terms of its net income. This is okay. This is not too much. It's starting to approach some levels that it may require some attention. But I think probably for the next decade or so, it's probably going to be safe, I would think. Now, in terms of the dividend, we kind of also want to take a look at our module here in our tool, where it actually shows you how much the dividend has grown through the years. One of the risks that I have that exists with these kinds of companies, and is one of the core risks that I think when I'm actually potentially buying a company of this sort, is what happens if they actually decide to cut down on their dividend. And they have to do that when their free cash flow is low, or their net income, of course, is low. And so when that happens, a lot of buyers that are actually holding the stock, do sell, because they are holding these kinds of stocks in order to make income. And so if their income goes down because the dividend was reduced, then they are selling, and you can have a precipitous decline in these kinds of companies. So you have to be always careful to be buying companies that are increasing their dividends, but they are not really, they don't really have any troubles potentially in the future paying their dividends. That's a very, very big thing. And one of the core ways to realize that is what I'm having here, the free cash flow payout ratio, very, very important. It has to be less than 50%, and it could be a little bit more, but less than 50%, it's much, much safer over here. And it does happen with this company. Now, let's take a little bit of a closer look at the income statement. Now, the income statement, 72 billion to 106, so they have been growing, and they have been growing nicely. Some years actually quite significantly. The pandemic is what we talked about in the article, remember? 20%, 30%. Now, I don't expect this to continue through the next few years. This is the typical thing that they do, 3%, something of that sort. But their net income 2.9 to 6.9, so as well, increasing as well pretty nicely. And this is why the company has been increasing their top and bottom lines very nicely, and their stock price through the years. But now it's kind of low, much, much lower, significantly lower, about 50% lower. Now, in terms of the total equity of the company, from 11.6 billion to 12.8, remember they have been buying back stock, so that's important. And they do have some liabilities of about 41 billion over here as well. Now, if you take a look at the cash flow statement, it kind of gives you the ratio of free cash flow to the liabilities, 40 billion to 5. It's about, like an 8, something of that sort. We did examine that earlier, remember. Over here, the tool actually tells you about this one with a handy little value, 8. It's 8 times free cash flow is the total liabilities. Let's go back. You will see here in the cash flow statement that the company has income that is always positive and then becomes like 8.6 billion in operating cash flow over here after the adjustments, mainly for depreciation and amortization, as you'll see, and kind of to be expected from a company of this sort. And a free cash flow of 4.3 to 5 over here, 5 billion. Pretty nice free cash flow for the company, which seems to be always in positive territory. And the last thing that I want to be doing, of course, is evaluate the company. Like, how much am I willing to pay today to buy this company based on what they are doing financially? Now, the revenue growth, as you'll see, the averages are more than you would want to use because of the last couple of years. This is the average again. You can kind of see it over here. The average revenue growth has been 8.7% in these 5 years. But we do want to use lower because typically the company does something like 3%. So I'm going to go 1, 2, and 3 here and just try that. Of course, in your projections, you could have different ideas about this company. But I think 1 and 2 and 3% can actually tell us a nice story about where to buy the company today. And the net income margins that the company has typically are about 5 to 6%. Now, they're a little bit lower. We did so examine that earlier. That's in the last few quarters. But overall, they do like 4, 5, and 6%. I'm going to go slightly lower, 3, 4, and 5 over here. That's the net income margin that we're projecting for the next 5 years. Remember, this is not just a quarter. So one quarter could be down, but overall, 3% or 4%, I think it's very achievable for the next few years. The free cash flow margins that the company has, again, a little bit all over the place, but typically I'd say they are close to 100, maybe a little bit less. So 80, 90, and 100, the typical one is what I'm going to use. And an annual return of 13%, what I typically ask for in my companies, from my companies. So I hit calculate here, and you will see that the low price is 76, the medium is 119, and the high one is 173, with the current being at 150. So with these kinds of projections, it's still a little bit expensive, target is. Yet, you could potentially accumulate just a little bit if you wanted to get a little bit of a dividend. That wouldn't be out of place necessarily. But I do feel that there may be some better companies over here. Now, if you are willing to go a little bit higher in terms of potential revenue growth, where the company will be achieving much, much better growth, you could potentially try like 3, 4, and 5%. This may be a little bit of a stretch. If you try that, you will see that we're getting much significantly better valuations over here, and we're approaching an even better buy price. So it does kind of depend on where you set up your, pretty much your levels in terms of revenue growth for the company. And of course, your net income margin would actually affect it as well, with the company typically doing something like 6%, frankly. So again, you could even go like 6 here, not 7. Let's go 6 everywhere over here. Let's see what we're getting out of this. And this is the nice thing about the tool. Like, you can use the tool and adjust the valuations according to what you want to achieve and what you think the company will be achieving in the next few years. And this is where we're getting all greens over here. Of course, you can do all these scenarios, play through all these scenarios by getting access to the tool, of course, which is available for patrons, with the link in the description box below this video, of course, if you're interested. And that's all. That's what I wanted to talk about. Target, maybe a little bit expensive yet, but interesting, and definitely one to keep in a watch list for sure. Thank you for watching. Remember to leave a like if you enjoyed the video, and subscribe, of course, if you are new around, and I'll see you soon. Bye-bye.